So ever since the collapse of Silicon Valley Bank, many banks have declined significantly this year, especially the regional banks like First Republic Bank down 80%. You've got banks like Credit Suisse down more than 95%. And you've got Silicon Valley Bank that's basically gone to zero. Big banks are down as well, but not too much. JP Morgan down 6%, Bank of America down 16%, Citigroup down 2%. Singapore banks have been holding up relatively well, but still down. DBS down 4.9%, OCBC down 1% year to date, UOB down 8.5%. So I've been getting a lot of questions from my students asking me, Adam, is this an opportunity to buy bank stocks? Are they cheap enough to buy and are they a safe investment? So let's explore this in this video. Now, before you ever think of buying bank stocks, I want you to understand that among the different kind of stocks you can buy, you could buy technology stocks, healthcare stocks, retail stocks, all kinds of stocks. Bank stocks are one of the most risky stocks you can invest in. Why? Because of the banking business model, banks are very highly leveraged by nature. All kinds of banks. They are leveraged an average of 10:1. So what does that mean? That means when you buy a bank, basically for every $1 of equity, they have $10 of liabilities. So they are very highly leveraged animals. And all banks are like that. So for example, if you take a look at Bank of America, which is one of the strongest banks in the world, you can see this is true as well. What's their total shareholders' equity? Their total equity is $273 billion US dollars. But what's their total liabilities? What's the total amount which they owe? You can see their total liabilities over here is $2.77 trillion. Okay, so if you take 2.77 trillion and you divide it by 273 billion, it's about a 10:1 ratio. So again, for every $1 of shareholders' equity, the bank takes $10 of liabilities. Right? So it's very highly leveraged. Now you can see that other kind of businesses, all kinds of other companies are not so highly leveraged, so they are relatively safer. So for example, look at Coca-Cola, which is a consumer defensive company. Coca-Cola, what's the total equity in the business? Total equity is $25.8 billion. And what's the total liabilities? Total liabilities is $66 billion. So for every $1 of shareholders' equity, they have about $3 of total liabilities. So their leverage is like 3:1, which is, okay, but banks are like 10:1. If you look at technology companies, now, one of the reasons why I love big technology companies like Apple and Microsoft is because they are relatively very, very safe because they use very little leverage. They've got very little debt. For example, look at Microsoft. Microsoft's total equity is $183 billion. What's their total liabilities? Their total liabilities is $181 billion. So in other words, for every $1 of equity, they've got less than $1 of liabilities. So can you see how banks, compared to other kind of companies, have a lot of liabilities? They are very highly leveraged, and that's what makes them relatively very, very risky. So why are banks like that? It's because of the fractional reserve banking system. It's their banking model. For example, if you go to the bank and you deposit $100, do you think the bank will keep your $100 there every day for you to take it out? No. By law, the bank can lend out up to 90% of the deposits. So out of the $100 you put into the bank, they lend out $90. So at any point of time, there's only $10 in the bank because the bank knows that you won't go there and withdraw all your money, right? You keep most of it there, or so they hope. Now, let's expand it. Let's imagine that the bank has 1 million customers and each customer deposits $100. So what's the total deposits? $100 million. Again, what does the bank do? Again, legally, the bank can lend out 90% of all those deposits. So the bank lends out $90 million and keeps only 10 million of the depositors' money in the bank. Now, that is what all banks do. Now, what do you think will happen if there's a panic and all the million customers run to the bank and say, we want our money back right now, or now we do it electronically where we withdraw all the money back? Can the bank give you back all your money? No, because 90% of that is lent out. So when that happens, the bank is screwed, and that's called a bank run. And that's how Silicon Valley Bank went bust. That's how Credit Suisse almost went bust, because of this run of the bank. Because again, by nature, banks only keep 10% of customer funds in there, and they lend out everything else, or they invest into bonds and other securities, which again, if the market value falls and they're forced to liquidate it to return depositors' money, they lose massive amounts of money. That's what again happened to Silicon Valley Bank. So again, before you ever think of investing in banks, please understand that they all have this inherent risk. They are very highly leveraged. If there's a panic and everyone wants their money back, the bank can go to zero. The bank can collapse. And that is what almost happened to Credit Suisse. And that's why it was forced to sell itself to UBS for 0.75 Swiss francs. And this was a bank that was trading at 18 francs just a couple of years ago. So it's like down over 95%. Now, not only are bank stocks very highly leveraged, but they also generally have very low growth, and they are very, very cyclical. What do you mean by cyclical? It means banks are companies that tend to make a lot of money during economic growth, but they make less money, or they even lose money during recessions. So their profits are like high and low and high. So it's very, very cyclical. And if you take a look at the long run, in general, banks underperform the S&P 500. So on this chart, you can see in blue, this is the S&P 500 over a 10-year period. KBE is the bank ETF that consists of all the banks in the US, the big banks, the regional banks, all the banks. So you can see that over the long run, banks in general tend to underperform the S&P 500. Then you may say, so why invest in banks? They are so risky, they are cyclical, they have low growth, they can't even beat the S&P 500 over the long run. Absolutely. But then again, there are some exceptional banks that are able to beat the S&P 500. Not many of them, but there are a few of them. So for example, Morgan Stanley beat the S&P 500. Bank of America, JP Morgan. In Singapore, you got DBS Bank. So there are banks that can outperform the S&P over the long run, but they are highly leveraged as well. So is there any point investing in bank stocks given that they're highly leveraged, they've got low growth, and they're cyclical? The answer is yes. However, I would say that only invest in the strongest banks, the highest quality banks only, and only buy them when they are very, very undervalued. Don't buy them under normal circumstances because it's not worth it. Only buy them when they are very, very cheap, and only buy the highest quality bank stocks. Now, generally for me, I rarely buy US bank stocks. I have bought Bank of America, JP Morgan, but I only buy them when they are very, very cheap during major crises. Like during the 2008 crisis, I bought it when it was really cheap. During the 2020 pandemic, I bought them when they were very, very cheap, but I've already sold them. And I've not bought them back because I don't think that they are really cheap enough for me. I only buy them when they're really, really cheap. But I do buy Singapore bank stocks purely for the dividends, and also because Singapore bank stocks are one of the safest in the world. They are very, very conservative, and the dividends are very attractive, and they are tax-free. So I buy them purely for dividends. So let me explain a bit more about what kind of bank stocks I think are safe enough to invest in. So again, before you consider a bank stock, always ensure that you only invest in the highest quality and the safest bank stocks in the world. So first of all, what do I mean by quality? By quality, I mean to say only invest in the most profitable bank stocks. So how do we measure profitability? Now, there are many, many ratios. I'm just going to focus on two main ratios or two main metrics. Number one, you want to ensure that over a 10-year period, minimum 10-year period through different economic cycles, the bank is able to be profitable at least over the last 10 years. You don't want a bank to be like making money, losing money, no, you want it to be profitable over a 10-year period. So we want revenue and net profit to be growing over the last 10 years. So let's look at a few examples. If you look at JP Morgan Chase, ticker symbol JPM, does it pass that criteria? Yes, it does. You can see over the last 10 years, revenue has been growing over time. Now, again, like I said, banks are cyclical, so they go through ups and downs. As you can see, they don't go up every single year. But generally, you want to see a general uptrend in the revenue and the profits. So again, revenue is growing, and again, profit is a bit up and down, the cyclicality, but overall, you can see it is generally growing. That's what we want to see. Another example would be, let's look at a Singapore listed bank, DBS Bank. Same thing over here. This is DBS Bank. You can see revenue growing over the last 10 years, profit growing over the last 10 years. We want these kind of banks only. Now, what we don't want is a bank like Credit Suisse. Credit Suisse fails that quality criteria. So that's something that you should never have ever invested in. Why? Look at the last 10 years. You can see the revenue has not been growing. The revenue, in fact, has been, revenue has been going down over 10 years. How about the profit? Profit has been very, very low. It's like making money, and then losing money, losing money, make money, lose money. Fails the quality criteria. The next very important metric of quality is the bank's return on equity, which is the net profit divided by the shareholders' equity. In fact, this is one of the most important things that our dear Warren Buffett looks at. And we want to ensure that when you buy a bank, the ROE is at least 10% or higher. The higher, the better, right? So a quick look at some of the bank stocks in the news. Now, you may say Silicon Valley Bank has a high return on equity. It's very profitable. Yes, it is, 12.1%. Now, again, just because it's profitable does not mean it is safe. So later on, we're gonna look at metrics to determine how safe it is. Right now, it's about profitability. So SVB passed that. So you can't just buy a bank just because it passed the profit criteria. It has to pass the safety criteria later as well. Okay, now DBS 14%, very high. OCBC 11%, UOB 11.9%. Credit Suisse, oh, that sucks. It's a low quality, minus 15%. JP Morgan 13%, and Bank of America 10.2%. All right, so that's the first filter, high quality. Credit Suisse failed the first criteria, but Silicon Valley Bank managed to squeeze through. But let's see if we can pass our other criteria. Now, when you take my value momentum investing course, my whale investing course, or my Wealth Academy live masterclass, I teach people how to analyze companies, how to analyze stocks. And what you have to understand is that the way you analyze a bank is totally different from the way you analyze other companies like retail companies and healthcare companies and technology companies. Banks are a totally different breed of company. So you have to analyze them very, very differently. So for banks, we have to look at 4 risks and to look at ratios that identify how risky they are. What are the 4 risks that banks face? The first is what we call liquidity risk. The second is what we call market risk or interest rate risk. The third is what we call credit or default risk. And the last would be reputational or operational risk. So let's look through them one by one. So what's the first risk? The first risk is known as liquidity risk. What does that mean? That means, does the bank have enough liquid assets to pay if the depositors want their money right now? Remember what I told you earlier on? For every $100 that you put into the bank does not actually have the $100 waiting for you. They lend out $90 or they use it to buy securities, and they only have, say, $10 in the bank at any point of time. So what happens if everyone rushes to the bank and says, we want our money now? The bank can't give you your money. They run out of liquidity, they run out of cash, and that's how they go bust. So how do we ensure that the bank we invest in is unlikely to face this kind of bank run like Silicon Valley Bank or Credit Suisse? So we look at 2 ratios to measure this liquidity risk. Alright, so join me in part 2 of this video where I'll run through all these important ratios that you have to look at before you invest in bank stocks. Also in part 2, I'll show you exactly the stocks I'm looking to buy, the bank stocks in Singapore and the US banks, as well as I'll show you how I calculate the fair intrinsic value and at what price do I think is cheap enough to buy these stocks. So all that in part 2 of the video, and I'll see you guys really soon. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.